Rivian Automotive, the electric vehicle startup, is facing a severe cash crunch and a looming threat of bankruptcy within the next 18 to 24 months if it fails to raise additional capital. Despite some positive developments, the company's path to profitability remains uncertain and its survival hangs in the balance. As you may know, Rivian is currently burning through cash at an alarming rate of around $1.5 billion per quarter. While Rivian delivered more than 13,500 vehicles, it lost nearly $39,000 per vehicle sold at a negative gross margin of 44% in the first quarter of 2024. At this cash burn rate, Rivian's $9 billion of total liquidity will last only 6 to 8 quarters, or 1.5 to 2 years. Despite management reiterating confidence in their outlook of positive gross profit margin by Q4 2024, the EV maker would still be burning about $1 billion per quarter in 2025 due to operational expenses, highlighting the unsustainable nature of its operations. Faced with this dire situation, Rivian is taking desperate measures to preserve cash and extend its runway, slowing production growth of existing models to conserve cash, moving initial R2 production to its normal plant to save $2.25 billion in capital expenditures and other costs, relying on an $827 million incentive package from Illinois to prepare the normal plant for R2 production. However, these measures are merely an attempt at the kicking bankruptcy can down the road, as Rivian is still a cash-burning furnace that could run out of money before the cheaper R2 enters mass production in early 2026. Since R2 isn't necessarily going to be a profit machine, Rivian's management is simply looking for a miracle, that is, fresh capital infusion. However, raising additional capital through debt or equity will be extremely difficult in the current high interest rate environment. Debt has become more expensive, and issuing new equity at Rivian's depressed stock prices would lead to massive dilution for existing shareholders. As I see it, Rivian's management is caught between a rock and a hard place when it comes to securing a fresh capital infusion. Despite Rivian's valiant efforts, I believe the company faces very high bankruptcy risk within the next 1 to 2 years, unless it can secure significant new funding, which appears unlikely given current conditions. As such, I maintain an avoid rating on Rivian stock because Rivian going bankrupt is a far likelier outcome than a successful turnaround. Rivian's future hangs in the balance as it grapples with a severe cash crunch and the looming threat of bankruptcy. Unless the company can secure a miracle in the form of fresh capital infusion, its survival beyond the next year or two remains highly uncertain. Investors should exercise caution and carefully consider the risks before investing in Rivian stock.